Hello and welcome to the Tax Roundup for February, and we're back in the saddle again. This month Michael is going to take you through two new tax determinations on capital gains and foreign trusts and why it's not that simple. There's a new tax ruling on depreciation and composite items, so whether they're treated as a group or individually. We're covering a really interesting case on tax residency and the tiebreaker tests, and this particular scenario the taxpayer was resident both of Malaysia and of Australia. But first up, Rae is going to take you through the new backpacker rules for employers employing those with 417 or 462 visas. Across to you, Rae.
Backpackers. Now, as we know, they did change the rules effective from the 1st of January 2017 for anybody who is employing backpackers. Those employers are now required to register so they can then have a special withholding rate that is 15% up to 37,000, and then the normal resident rates after that if the backpacker's told you the resident. If the employer is not registered, they're supposed to withhold a 32.5%. Now, there are penalties for employers who either A, aren't registered, or B, are registered but withhold the wrong amount. So it's really important that the employers who are employing those backpackers get the rates right. Also, another reminder for anybody who might be employing backpackers, if any employer in Australia is employing somebody other than an Australian citizen, it is the employer's responsibility to make sure that person is in Australia on a visa with appropriate work rights. Now, there is a tool on the immigration website that allows you to verify the visa status of any employee or potential employee, and the link to that is included in the tax roundup. So please make sure to check that. For the employees, so the backpackers themselves, they'll have to recognise that for the 2017 tax year, the tax return might be a little bit more complicated because the first half of the year they have the old rules, the second half of the year they have the new rules and the new tax rates. We haven't seen any guidance from the ATO about exactly how that's going to work when they do the 2017 return. There might be a few extra boxes, or there might be something else going on behind the scenes in the ATO system. So hopefully we'll get some further guidance about that before the end of this tax year, and then we'll let you know through the roundup. Thank you.
And in tax rulings and determinations, Michael is going to take you through those two tax determinations.
Now, the ATO has released two draft tax determinations which are quite closely related to each other. So we're just going to have a look at them, I guess, as one piece. TD 2016/D4 and D5 are the two documents. Basically what they're looking at is a situation where a foreign resident trust has disposed of assets that are not taxable Australian property. So we might be talking about shares overseas or foreign real property overseas somewhere. Now, the reason the ATO has released some guidance in this area is because there's always been a bit of uncertainty about how do you actually apply the rules in this case. And the reason for that is that the basic trust taxation rules here in Australia say that when you are performing the taxable income calculation for a trust, you basically have to pretend that it is a resident trust, regardless of what its actual residency status is. Now, where that gets tricky is that when a foreign trust is disposing of foreign assets, in the CGT rules, there's certainly an indication that those should be ignored. So the question is, well, do you just ignore the basic rule that says you have to deal with it as if it was an Australian trust, even though it's a foreign trust? So basically these documents are looking at how do you deal with the interaction between those two provisions. Basically what the ATO says is that if you have a foreign resident trust disposing of non-taxable Australian property assets, then they get ignored. You don't put them in the taxable income calculation of the trust. So you kind of ignore the bit that says you have to pretend that it's an Australian trust just for the purpose of doing that CGT calculation. Now, in some ways that might look like a good thing because you're leaving out these certain capital gains from your Australian taxable income calculation. Where the second document kicks in though is it says, well, if you end up distributing some of those capital gains to an Australian resident beneficiary, well, they actually get taxed under a separate provision. And there's a section called 99B which basically says that if you're an Australian resident beneficiary and you've received a distribution from a trust, often a foreign trust, where that represents something that would have been taxed to an Australian resident, then you're assessed on it. Now, the downside to that is that as an Australian resident beneficiary being taxed under that provision, you don't get access to the CGT discount. You also can't offset your own capital losses against that amount that you're being taxed on, even though it relates to a capital gain that was made by the foreign trust. So it's a bit of a trap. On the one hand, it kind of looks, oh good, we get to leave out this capital gain from our calculation, but if it ends up back in the hands of an Australian resident beneficiary, it still gets taxed, but in a worse way. So really a danger that kind of practitioners need to be on the lookout for with their trust clients where you have foreign trusts involved. Now, one of the things that is not clarified at the moment in those draft determinations is what's the position of a temporary resident beneficiary. So it might be an Australian resident beneficiary who has temporary resident status. What happens if they receive that distribution? At the moment, that's not really clarified in the documents. We've actually lodged a submission with the ATO asking for clarification. Hopefully when these documents get finalised, that position will become more clear. But it certainly looks like you could end up with a slightly different result if you had a temporary resident beneficiary. So again, that issue around residency status becomes all important.
Now across to Rae for depreciation and composite items.
The ATO have noticed there's still a lot of taxpayers out there who seem to misunderstand the rules in relation to depreciation and whether they have a single depreciable asset or just lots of different assets that just happen to be using together. So they've issued guidance in TR 2017 D1, which outlines the factors they would consider when you're determining, do you have a composite item that you're using as part of a single depreciable asset, or whether you have different assets altogether. So included amongst the factors they have is, what's the use of the item? Is it separately identifiable? Is it used as part of a system? They also have a lot of examples in this draft ruling, which helps to outline the points that they're trying to raise. Now, one example is whether you might have a new tower computer system. So you've bought the box that sits on the desk, the monitor, the keyboard, the wireless mouse. All those things together operate as one system to be able to now allow you to use the computer. Without one of them, you can't use the computer altogether. So that is a single depreciable asset. Well, what happens if you buy a second monitor? You can plug that in and make your use of the system more effective, but you don't need it. You could unplug it and use it somewhere else. You could use it separately, you could plug it into a different item altogether. That would be a separate depreciating item. So it's important to remember when you're looking at those small things together, are they a single depreciable asset? Or are they different items? This is going to be particularly important for SBE taxpayers when they're looking at using the immediate deduction threshold that's higher until the 30th of June 2017, and whether those things they buy during the 2017 tax year will get an immediate deduction, or whether they're all grouped together and you're looking at a longer period for the deductions.
And finally to Michael on that case of tax residency and the tiebreaker tests.
In cases this month, we're looking at an AAT decision, the Beng Tan and Commissioner case. This was a residency case, and the reason we're picking this up is because even though we've seen lots of cases dealing with residency over recent years, this one looks at it from a slightly different point of view, because in this case, the taxpayer and the Commissioner actually agreed that the taxpayer was a resident of Australia. So that in itself wasn't really an issue. However, this taxpayer was also a resident of Malaysia. So the issue became, well, if you've got someone who's a resident of both countries, there's a double tax agreement between Australia and Malaysia, it means you now have to consider the tiebreaker tests in that double tax agreement. Now, this is something that sometimes gets overlooked in practice in terms of easier to look at the Australian residency rules. You don't necessarily get an easy answer, but we know they're there, we know we have to look at them. What sometimes gets overlooked is the importance of then going that step further and seeing, well, could this person also be a resident of another country? If so, does Australia have a double tax agreement with that country? If so, we're going to have to work through the provisions in the agreement to see how they would be treated when it comes to applying the remaining provisions of the treaty, because that will impact on where certain income will be taxed. Now, in this case, again, the parties agreed that this person was a resident of Australia. We got into the tiebreaker test. The first one looked at, did this taxpayer have a permanent home available to them in Australia and or in Malaysia? Now, in this case, the Commissioner said, well, he did have a permanent home available to him in Australia. The taxpayer argued, well, it wasn't really my home, it's my parents' home. I live in it occasionally, but it's not really a permanent home that's available to me. The AAT agreed with the Commissioner and said, look, there was no formal arrangement here, but informally, you were allowed to live there. You had lived there for quite a substantial period of time. This taxpayer had left personal belongings there. He had a key that he carried with him. He was able to come and go as he pleased. So the Commissioner was right in that case. The AAT said this was a permanent home in Australia. Now, this person also had a permanent home available to them in Malaysia, which meant you then had to go to test number 2. Test number 2 looks at your habitual abode. Again, the parties agree that that was in both countries. We then had to go to step number 3. Step number 3 looks at, you have to identify which country the taxpayer has closer personal and economic relations to. Again, this is where a big argument came up. The taxpayer said, well, I do have some things here in Australia, I have some connections, but they're much stronger in Malaysia. Now, the Commissioner wasn't in agreement with that, and certainly the AAT said, look, yes, there are some connections with both countries. They are far closer to Australia. Most of your assets are here in Australia. Your family, most of them are resident here and spend most of their time here. Business was located here in Australia. When you are asked for your address, you always give your Australian address. When you leave Australia, your outgoing passenger card says that you're leaving temporarily. When you're coming back to Australia, your passenger card says that you're coming back home, basically. So the AAT said, on the evidence available, those personal and economic relations were far closer in Australia than they were in Malaysia. That meant that this particular taxpayer was deemed to be a resident of Australia under the tiebreaker test in the treaty. Now, that's important because it meant that certain foreign income could then be taxed in Australia, and that had a huge difference and a huge impact on the amount of tax payable by this particular person in that income year. So again, slightly different way of looking at residency issues. We've seen the Commissioner really attack residency cases over the last few years. It's something that practitioners need to be really on top of, and this just demonstrates the importance of going that extra step further, looking at the double tax agreements. And again, we've got to look at all the facts. What are the facts saying? Make a considered judgment based on those facts.
And that's the tax roundup for this month. For members of Knowledge Shop, don't forget to register for PD. It's on February, March. We're covering some really interesting issues. There's an FBT update, and we're looking at those new rules on website depreciation, so something most companies can't do without. If you're not a member of Knowledge Shop, give Julie a call on 1800 800 232 and see what's on offer for your firm. Speak to you soon.